If you want high income and the diversification offered by the S&P 500, these are my top 3 choices. SPYI pays the highest yield. 11.94% is, well, a lot of income. But what about the total return? JEPI is the most popular. It has 38 times more assets under management than the other 2 combined. But does that make it the best? This is my first time doing a 3-way comparison, and it will get you up to speed pretty quickly on how these ETFs turn the S&P 500 into a cash machine. Let's start with the income because that's the whole reason we buy these funds. You already know which one of the 3 pays the highest yield, SPYI, so let's take a peek at those distributions. We can see a reasonably consistent monthly payout. At 11.94%, SPYI is also currently the highest yield of the stocks and funds in my top 10 high yield favorites playlist. I made a sample portfolio of that playlist, and you can see that SPYI is leading the pack. The green line represents the yield on cost, which is a bit higher at 12.57% based on a purchase at the beginning of 2023. Unfortunately, I waited until September 2023 to buy it. If you own more than a few dividend stocks, dividend trackers like this are pretty handy. I did a full comparison of my 2 favorites in this video, and there's a link in the description for an exclusive discount on Snowball Analytics if you decide to keep using it after the free trial. QDPL is also quite consistent when it comes to distributions. I was keeping an eye on the distribution amount because it went from 53 cents to 52 cents and then to 51, but then in December 2023, it popped back up to 53 cents, so it wasn't a downward trend. So far, so good. Note that QDPL distributes quarterly, the other 2 funds distribute monthly. I'm showing you the full distribution history for each so that you get a feel for the trends or lack thereof. When we switch to JEPI, it's a different picture. There are more distributions because they pay monthly, and the payouts vary dramatically from a low of 26 cents to a high of more than double that, 62 cents. Why the dramatic difference? Well, different strategies, which we'll get to shortly, but in simple terms, SPYI is actively managed with consistently high yield as a priority. QDPL uses futures to multiply the S&P 500 yield by a factor of 4, and the S&P 500 yield is reasonably consistent. Meanwhile, JEPI outsources the income portion of its fund to banks using equity-linked notes or ELNs. Whatever yield those ELNs happen to produce that month is what you get. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in far greater depth because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of 8% plus. As explained in this video, the average yield of the 3 funds discussed today is currently 8.86%. The yield only tells part of the story. We need to include the price history to understand the performance of these funds. We'll go back as far as the youngest of the 3, SPYI, which was launched on August 30th, 2022. That was a nice round 500 days before I prepared the research for this video. Currently, the S&P 500 benchmark is in the lead with a total return of almost 23% over that period. That's great, but it doesn't help you if you're an income investor because it pays a yield of less than 1.5%. Also, at various times, it underperformed. The most obvious example was coming out of the 2022 bear market. JEPI clearly outperformed the S&P 500 during that period. For most of the 500 days, the performance of the other 2 funds, SPYI and QDPL, closely matched the S&P 500 benchmark. That was until November 2023 when the S&P 500 and QDPL pulled ahead of SPYI and JEPI. 500 days isn't a lot of data, but this tells me that of the 3 funds, QDPL performs the best in a bull market, JEPI performs the best in a bear market, and SPYI is in the middle but offers the highest yield, and a fairly consistent one at that. Here's a quick look at how these funds generate their income. 2 of the 3 are covered call funds, JEPI and SPYI. About 80% of the JEPI portfolio consists of stocks selected from the S&P 500, but it's not the same as the S&P 500. The S&P 500 has, as you could probably know, 500 stocks. JEPI currently holds about a quarter of that, 134 4 stocks. S&P 500 is market cap weighted, so Apple and Microsoft are roughly 7% each at the moment. JEPI weightings are much lighter. The largest weighting, also Microsoft, is less than 2%. Below that is Adobe at 1.7%, and Adobe isn't even in the S&P 500 top 10. It's down at number 23. So now you can see why they perform differently. The S&P 500 favors the biggest companies, and JEPI favors the companies that the fund managers believe are the best value. As I mentioned earlier, approximately 20% of the fund is in equity-linked notes, ELNs. Their purpose is to generate income by selling covered calls on the S&P 500 index. That's an option income strategy where you sell the right to the upside of an investment above an agreed upon price, and they do this every month to generate income. SPYI is much simpler. No ELNs and no trading of individual stocks. JEPI and SPYI both generate income selling covered call options, but JEPI outsources that function and SPYI does it in-house. In fact, that's the whole focus of this fund. The portfolio managers are option specialists. They actively manage when to sell the calls, what percentage of the holdings to sell them on, and at what strike price. That's a separate skill from picking individual stocks, and based on the income they've generated so far, they're pretty good at it. If QDPL doesn't sell covered calls, how do they generate income? Thermonuclear fusion. Just seeing if you're still paying attention. Actually, they use futures contracts. Approximately 12% of the fund sits in cash and treasuries and acts as collateral. And that collateral is used to enter futures contracts based on just the dividend portion of the S&P 500, not the price portion. It's a little bit complicated, but it's all brilliantly explained by this guy, Professor Van Binsbergen from the Wharton School, in a review presented by this guy. The other 88% of the fund just buys the same stocks in the same weightings as the S&P 500. Simple. I breezed through those pretty quickly, but if you want more detail on how each of these funds works, I have detailed reviews on all of them, along with this JEPI update, and that explains why JEPI performed better in 2022 than it did in 2023. JEPI is the least tax efficient of the three and distributes mostly ordinary income and a small amount of qualified income. SPYI and QDPL are more tax efficient than most income funds. Their index-based strategies allow them to treat the majority of their distributions as return of capital. Important to note that's a tax treatment, not a return of the investor's principal. The effect of return of capital is that you don't pay tax on that income now. Instead, it lowers your cost basis, and when you sell, you pay capital gains tax, which for most people is at a lower rate than the tax on ordinary income. JEPI charges the lowest fee at just 0.35%, but 0.35% of $30 billion under management is $105 million. There's just 2 portfolio managers plus their staff, bringing in 105 million big ones per year. A lot of people talk about what a great deal 0.35% is for investors. It's not too bad for JP Morgan either. Pacer charges 0.79% for its QDPL fund, and NEOS charges 0.68% for SPYI. These two are closer to the typical range for an actively managed fund. NEOS is the newest and smallest of the 3 fund managers. All they do is option ETFs. One of the founders, Garrett, has appeared on this channel. We discussed the risks of covered call funds, which is a nice segue into the next topic, risk. But before we jump into that, articles like this one on SPYI were a helpful source of information for this video and for my investing in general. If you haven't tried Seeking Alpha, there's a link in the description for a free trial and a discount if you decide to join. I don't buy a stock or a fund without first checking it on Seeking Alpha. Let's look at risk, or to put it another way, why I don't put all my money into these 3 funds. For the 2 covered call funds, JEPI and SPYI, the risk is the slow recovery after a market crash. If the S&P 500 crashes and then quickly recovers, as it did in 2020, covered call funds won't recover as quickly as the S&P 500 because their upside is capped. Covered call funds do well in sideways markets or periods of gradual appreciation. JEPI has the additional risk of using ELNs, which are opaque, meaning we don't have access to information about the individual option trades. What's the risk for QDPL? It uses futures contracts that are based on the S&P 500 Dividends. S&P 500 dividends generally increase over time, but if they do take a hit like they did during the 2008 global financial crisis, it would have an outsized impact on this fund's income. This isn't a huge risk because historically, large drops in the S&P 500 dividends are rare, and even though it affects QDPL more than the index, it still doesn't move the needle that much, and it's likely to recover anyway. What about this $2.7 billion ETF? There's one other fund I haven't mentioned, even though it has a longer history and far more assets under management than QDPL or SPYI, and that fund is XYLD from Global X. From the people that brought you QYLD, I'm not really a fan, comes an S&P 500 covered call fund with a pretty sizable yield. Why didn't I include it in this review? Because the calls are written at the money, which lowers the cap on appreciation more so than for the funds that I've reviewed today. I'll conclude this little diversion by showing total returns for XYLD versus the others over the past 500 days, and you can see it's the loser. I have a full 5% position in SPYI, which is the maximum I put into any stock or fund, and I have a 2% allocation to JEPI. It's more of a value approach, so I don't expect it to perform as well as SPYI, but as we've seen, it shines during a down market, which smooths out the bumps. I don't currently hold QDPL. That futures strategy is unique, so I've been waiting for it to establish a longer track record and prove itself. So far, so good. I am open to holding it and will probably start with a small position and gradually increase it as long as it continues to keep up with its benchmark, the S&P 500. Ideally, I'd like to see how it recovers from a major correction before trusting it with a full 5% allocation. Before I go, I've reviewed a lot of stocks and funds on this channel, but if you want to see the top 10 favorites I mentioned a little bit earlier, I'll put up a link to that playlist over here. That wraps it up for this look at high yield S&P 500 funds. More armchair income very soon.